Something just broke in the architecture of global finance, and the fracture isn't visible in any price chart or trading session. It's buried inside a document that was published in the dead hours of a weekend when no one was watching. A document that rewrites 53 years of monetary law. A document that activates tomorrow morning. A document that transforms precious metals from speculative commodities into mandatory banking assets with the stroke of regulatory mathematics. The Basel III Endgame protocols are now binding on every major financial institution on the planet. And what these protocols mandate, what they force banks to execute starting tomorrow at market open, represents the most significant shift in precious metals since the gold window closed in 1971. They remonetize gold and silver, not through political theater or central bank announcements, through regulatory force that makes holding physical precious metals a capital adequacy requirement. The surface event appeared routine: new banking regulations, adjusted risk weightings, technical modifications to capital framework, the kind of regulatory fine print that financial media ignores and markets dismiss as bureaucratic housekeeping. But this isn't regulatory housekeeping. This is the controlled demolition of the paper precious metal system. This is the systematic weaponization of banking law to force institutional accumulation of physical metals within a mathematically impossible time frame. The transition wasn't supposed to be this obvious. The shift was designed to happen gradually through market forces and natural evolution. The regulatory changes were meant to nudge behavior, not mandate it through compliance deadlines. But something went wrong with the gradual approach. Someone realized the paper system was approaching terminal instability faster than anticipated. Someone deployed the nuclear regulatory option to manage a crisis that was becoming unmanageable. This is where things stopped making sense to anyone still believing in market-driven price discovery. For over 5 decades, banking regulations have actively discouraged precious metals ownership. Physical gold and silver carried 50% risk weightings, meaning banks had to hold additional capital against metals positions. The regulatory framework treated real money as a speculative risk, while treating government paper as safe assets. This created the mathematical foundation for paper market dominance. Why hold physical metals that penalized your balance sheet when you could trade unlimited synthetic positions that improved your regulatory ratios? Tomorrow morning, that incentive structure inverts completely. Physical gold and silver held in allocated form receive 0% risk weighting under the new protocols. They count as Tier 1 capital at full value. They strengthen bank balance sheets instead of weakening them. They satisfy regulatory requirements instead of consuming additional capital. Meanwhile, paper precious metals positions get classified as high-risk derivatives with 85% risk weightings and double funding requirements. Unallocated positions become capital-intensive. Synthetic exposure becomes economically prohibitive. The regulatory system now punishes banks for holding paper metals while rewarding them for accumulating physical inventory. This doesn't happen by accident. Banking regulations don't accidentally reverse their fundamental incentive structures overnight. This represents coordinated preparation by entities that knew exactly what was coming and positioned regulatory ammunition accordingly. Someone understood the paper market was approaching systemic breakdown. Someone calculated the timeline for collapse. Someone prepared the regulatory framework to manage the transition before market forces made management impossible. The timing reveals the coordination. These protocols don't phase in gradually over quarters or years. They activate simultaneously across every major banking jurisdiction tomorrow morning. Every central bank received identical instructions on identical implementation schedules. The Federal Reserve, European Central Bank, Bank of England, Bank of Japan, and People's Bank of China all implementing the same regulatory changes at the same moment. This level of coordination requires years of preparation and absolute control over the global regulatory apparatus. But there's a deeper layer that exposes the true desperation driving these emergency protocols. The regulations don't just incentivize physical metals ownership. They systematically destroy every mechanism that enabled paper market manipulation through punitive capital requirements that make synthetic positions economically suicidal. Short positions in precious metals trigger additional Tier 1 capital requirements equal to 10% of notional exposure. A bank maintaining $1 billion in short silver positions must hold $100 million in additional capital against that exposure. This capital comes from shareholders. If a bank is tying up $100 million to maintain short positions that generate minimal trading profits, that represents single-digit return on equity. Shareholders revolt. Management faces pressure to eliminate the capital-intensive positions. The mathematics are designed to make naked shorting impossible. The regulatory costs exceed any possible profit from maintaining short exposure. Banks have no economic choice but to cover short positions and eliminate paper leverage. And the evidence suggests this covering process is already underway in the 48 hours before the protocols activate. COMEX Silver open interest has collapsed by 47,000 contracts since the protocols were announced. That represents 235 million ounces of paper silver positions, eliminated as banks rush to close exposure before the capital requirements take effect. Gold, open interest, dropped by 180,000 contracts in the same period. 18 million ounces of paper gold disappearing from futures markets as institutions scramble to avoid regulatory penalties. This isn't normal market activity. This is panic liquidation by entities that understand the implications of tomorrow's regulatory shift. This is systematic position covering before compliance costs make maintaining those positions economically destructive. But the covering represents only the beginning of the forced buying cycle that these protocols engineer. According to banking system data, global institutions maintain $680 billion in unallocated gold positions and $94 billion in unallocated silver positions. Paper claims without physical backing. Fractional reserve promises. Under the new protocols, these positions require physical backing or face punitive risk weightings. Conservative estimates suggest 30% will convert to physical backing. That requires acquisition of 96 million ounces of gold and 350 million ounces of silver within 78 days. The arithmetic becomes impossible. Global gold mine production totals 110 million ounces annually. Banks need nearly a year of mining output in 11 weeks. Global silver mine production equals 827 million ounces per year. Banks need 5 months of production in 11 weeks. But available silver for institutional purchasing might total 20 million ounces monthly. Banks need 350 million ounces. The market can provide 52 million ounces. The shortfall exceeds 298 million ounces. This gap cannot be bridged through normal supply channels. Mine development requires 15 years. Recycling flows are limited by existing scrap availability. Industrial demand shows no elasticity at current price levels. The only variable that can adjust to resolve the shortage is price. The price must rise until existing holders agree to sell, until industrial users reduce consumption, until equilibrium is restored between mathematically impossible demand and geologically constrained supply. Someone engineered this supply-demand imbalance through regulatory design. Someone understood that forcing institutional buying within an impossibly short time frame would create the most acute shortage in precious metals history. Someone designed these protocols to guarantee dramatic price adjustment through compliance mathematics rather than speculative forces. But the regulatory weapon targets more than just institutional positions. It systematically destroys every form of synthetic precious metals exposure that retail investors rely on for market participation. Banks offering unallocated precious metals accounts must notify holders within 30 days. Convert to allocated storage with fees, liquidate to cash at current prices. None of these options preserve investor positioning. Converting to allocated storage requires banks to acquire physical metal that doesn't exist. Liquidating to cash forces investors out exactly when regulatory mandates guarantee institutional accumulation. Rolling into debt securities transforms metal ownership into credit exposure. The regulatory framework creates perfect demand convergence. Institutional buyers need hundreds of millions of ounces. Unallocated account holders need physical conversion. Paper position holders need physical alternatives, all targeting the same constrained supply over the same 78-day window. Someone orchestrated this confluence. Someone timed the regulatory changes to maximize demand concentration. Someone engineered the system to create the most extreme supply shortage possible within the legal framework of international banking law. The preparation required modeling every aspect of global precious metals, supply and demand, understanding mine production schedules, calculating recycling flows, mapping industrial consumption patterns, analyzing investment holdings across every major market. This wasn't designed by regulatory bureaucrats. This was engineered by entities with complete access to precious metals market intelligence and the authority to reshape international banking law across multiple sovereign jurisdictions simultaneously. The protocols reveal insider knowledge of paper market vulnerabilities that only system architects possess, understanding of supply constraints that only comes from controlling the flows, awareness of demand elasticity that requires access to confidential industry data. Someone with absolute knowledge of precious metals market mechanics and unlimited regulatory authority designed these protocols to achieve a specific outcome: the systematic destruction of paper markets and forced repricing of physical metals to levels that reflect actual scarcity rather than synthetic abundance. The regulatory weapon has been constructed through years of coordination. The targeting has been calibrated through extensive modeling. The timing has been synchronized across every major financial jurisdiction. Tomorrow morning, the weapon activates, and the precious metals markets begin their transition from paper fantasy to physical mathematics. The banks understand this transition is mandatory. The position covering has already begun. The panic is spreading beneath regulatory compliance language that masks the desperation driving these emergency measures. But the broader market remains unaware that tomorrow morning represents the end of 5 decades of precious metals demonetization and the beginning of their systematic remonetization through regulatory force. The countdown has expired. The transformation begins in less than 12 hours. And while institutions scramble to comply with protocols they cannot avoid, most investors still believe they have time to position themselves before the mathematical inevitabilities begin to unfold. The regulatory architecture has been weaponized. The supply-demand equation has been engineered. The timing has been synchronized globally. Tomorrow morning, 53 years of precious metals manipulation ends not through market revolution, but through banking compliance requirements that make continuation mathematically impossible. The regulatory weapon doesn't fire once. It fires in coordinated volleys designed to overwhelm every defensive mechanism that kept the paper system functioning. Wave 1 began with position covering as banks rushed to close short exposure before tomorrow's compliance deadline. Wave 2 starts tomorrow morning when Tier 1 capital requirements take effect and make physical metals mathematically superior to paper alternatives. But Wave 3 represents the true devastation. That is when unallocated account holders receive their 30-day notices and realize their paper claims are being terminated or converted under conditions that destroy their positioning. Millions of investors believe they own precious metals through unallocated accounts and synthetic products. They're about to discover their protection was an illusion. And when account holders learn their positions are being closed, some will panic. When they discover conversion requires fees and delays, some will demand immediate liquidation. When they realize banks don't have physical metal to back the promises, some will seek alternatives. This retail panic compounds institutional buying. Banks need 350 million ounces for compliance. Account conversions could add another 100 million ounces. 450 million ounces of demand, targeting 52 million ounces of supply. Someone calculated this demand multiplication. Someone understood forced account closures would trigger retail buying that amplifies institutional demand. Someone engineered maximum panic through synchronized destruction of every paper alternative. The timing ensures there's no escape valve, no alternative market to absorb the displaced demand, no secondary channel to relieve the supply pressure. Physical dealers are already reporting allocation delays and premium increases as early positioning begins ahead of the regulatory activation. When institutional buying officially begins tomorrow morning, these supply constraints will intensify exponentially. But the supply shortage represents only one dimension of the crisis these protocols engineer. The other dimension targets the entire dollar-denominated financial system through forced asset liquidation. Banks need hundreds of billions of dollars to acquire the physical metals required for compliance. They don't print money. They must sell existing assets to raise the necessary capital. U.S. Treasury bonds, corporate debt, equity positions, real estate holdings. Massive institutional selling across multiple asset classes to fund precious metals purchases. This liquidation pressure hits markets already weakened by geopolitical tensions, inflation concerns, and economic uncertainty. The correlation breakdown accelerates. Traditional portfolio diversification fails when all dollar-denominated assets face selling pressure simultaneously while precious metals face unprecedented buying demand. Someone designed this correlation breakdown. Someone understood that forcing institutional asset liquidation to fund metals purchases would destabilize the entire financial ecosystem. Someone engineered maximum systemic stress through regulatory mandates that appear neutral but create cascading instability. The Federal Reserve faces an impossible choice. Allow asset prices to collapse under institutional selling pressure, or intervene with liquidity injections that accelerate the inflation driving precious metals demand in the first place. Either choice validates the thesis underlying the regulatory shift. Dollar-denominated assets cannot provide the stability that physical metals offer during monetary system transitions. The European Central Bank confronts the same dilemma across bond markets that are even more fragile than their American counterparts. Asian central banks watch their currency reserves lose purchasing power as dollar weakness accelerates. This isn't coincidence, this is coordination. The regulatory protocols activate simultaneously across jurisdictions that rarely agree on anything. The timing creates maximum pressure on every major central bank at the same moment. Someone orchestrated this global regulatory synchronization to prevent any single jurisdiction from absorbing the displaced demand or providing alternative supply channels. But there's an even deeper layer that reveals the true intention. The 78-day compliance window coincides with other systemic pressures. Geopolitical tensions escalating, currency swap agreements expanding among BRICS nations, trade settlement shifting away from dollar dominance. The regulatory protocols force precious metals accumulation during the precise window when monetary alternatives are emerging and dollar hegemony faces its most serious challenges. This isn't regulatory housekeeping. This is monetary warfare disguised as banking compliance. This is systematic preparation for a post-dollar architecture where precious metals resume their historical monetary role. Someone knew this transition was inevitable. Someone positioned regulatory mechanisms to manage the shift before market forces made management impossible. The protocols create plausible deniability. Banks aren't abandoning the dollar system. They're complying with regulatory requirements. Central banks aren't engineering currency debasement. They're maintaining financial stability through established frameworks, but the mathematical consequences remain the same regardless of the stated intentions. Massive institutional demand for physical metals in markets with insufficient supply, systematic liquidation of dollar assets to fund compliance purchases, escalating pressure on monetary authorities who cannot resolve the contradictions through traditional policy tools. The regulatory architecture has been weaponized to achieve monetary system transformation through banking compliance rather than political declarations. The implications extend beyond precious metals markets, beyond banking regulations, beyond national monetary policies. This represents the controlled demolition of the Bretton Woods system that has governed international finance since 1944, the systematic replacement of dollar-centric arrangements with mechanisms that acknowledge physical scarcity as the ultimate arbiter of monetary value. The transition won't be announced through dramatic summits or treaty negotiations. It will happen through regulatory compliance deadlines, capital adequacy requirements, and risk-weighting adjustments that make the old system economically unsustainable for the institutions that supported it. Tomorrow morning begins the final phase of a monetary revolution that has been planned for years and calibrated to appear inevitable rather than engineered. The regulatory weapon represents the culmination of decades of preparation by entities that understood the mathematical impossibilities embedded in infinite debt expansion backed by finite resources. These entities positioned themselves for the transition while creating the legal mechanisms to force institutional participation in the new paradigm, whether they understood it or not. The 78-day countdown isn't a compliance timeline. It's a liquidation schedule for the paper precious metal system. It's a forced migration from synthetic abundance to physical scarcity. It is the mathematical reconciliation between promises that cannot be kept and resources that cannot be printed. The broader population remains unaware that their monetary system is undergoing fundamental transformation. The financial media treats regulatory changes as technical adjustments rather than revolutionary shifts. Market participants focus on price movements rather than structural fractures, but the entities that engineer monetary systems operate on timescales measured in decades rather than trading sessions. They positioned themselves for this transformation long before it became visible to markets that react to symptoms rather than causes. The regulatory protocols represent the visible symptom of a much deeper shift that has been underway since the last financial crisis exposed the mathematical impossibilities at the heart of infinite debt expansion. Tomorrow morning, the symptoms become acute. The contradictions become unavoidable. The choices become binary: physical metals or paper promises, scarce resources or synthetic alternatives, mathematical reality or financial engineering. The regulatory weapon forces this choice on institutions that would prefer to avoid it, that would rather maintain profitable illusions than confront uncomfortable truths about the sustainability of systems built on exponential expansion within finite constraints. But mathematics doesn't negotiate. Physics doesn't compromise. Geology doesn't accommodate financial innovation. The regulatory protocols simply align legal requirements with physical constraints that were always there but carefully ignored as long as the contradictions could be managed through increasing complexity. Tomorrow morning, the complexity collapses. The contradictions surface. The mathematical realities that were hidden behind regulatory arbitrage and paper promises become unavoidable through compliance requirements that cannot be evaded or delayed. 53 years of monetary experimentation ends not through market revolution or political upheaval, but through banking regulations that make continuation of the experiment economically impossible for the institutions that enabled it. The weapon fires in less than 12 hours. The transformation accelerates whether markets understand it or not. And while most observers focus on price changes and position adjustments, the deeper shifts that drive surface phenomena remain hidden beneath compliance language designed to obscure rather than reveal the magnitude of what's actually happening. By the time the broader implications become obvious to everyone, the new system will already be operational, and the old alternatives will have been systematically eliminated through regulatory requirements that appeared technical but were actually revolutionary. The countdown is over. The choice has been made for institutions that thought they could avoid it forever. And tomorrow morning begins the final phase of a transition that will reshape international finance, whether participants understand the process or not.